Hi, everybody. It's Larry Berman here on the eve before my back surgery. Many of you who will have reached out with emails, so appreciate all that. Should be, pretty standard stuff. I'll be out for a couple of days, but back at it before you know it. And so we're pre-taping tonight's episode. We have a great guest on from BMO, as always, our educational partner, talking about option overlays. I'm going to spend a little bit of time tonight. This week on BNN, I talked about energy transition as something that I have a strong view on. And I think with the political season in front of us here and what's going on now in Sharm el Sheikh in Egypt, an interesting topic. But I'm going to dive in a little bit on covered call strategies, when to do it, how to do it, what kind of ETFs we can use to do it, etc. So pretty excited for tonight's show. It's going to be a little bit shorter than usual. Just didn't have time to get to all the questions that people wrote in. We've got just a couple I'll go through, but it'll be a little bit shorter tonight. Hope you can all understand and appreciate that. Once again, thanks to all our partner companies that put these events together, and in particular to our educational sponsor, BMO ETFs. Many of you already have made donations to one of our two charities to thank us for these educational efforts. BMO has been a great supporter of our charitable efforts over the years, and just thrilled to be doing this and giving back. Cancer research at sick kids, something very close to us at ETF Capital Management and Q Wealth, and dementia and Alzheimer's research at the Baycrest Foundation. In the email following up to tonight's presentation, you will get a copy of it. There will be a couple links on there. Hit those links, make your donations, and we'll be thrilled to match them. So moving on, got a great talk tonight about covered call ETFs, covered call strategies, how to understand them a little bit better, again, from an educational perspective. Om Karmakar, I'll turn it over to you. I will go off camera and I will be back in a little bit.
Perfect. Thanks, Larry. So we can get started. So today's topic is on covered calls and how we can maximize, how clients can maximize their income using covered call ETFs. So if you go to the next slide, we can, one more, and then we can get started on.
Well, you want to make sure to tell everybody that this is not investment advice.
Oh,
it's
sure.
Educational only.
Yeah.
When I talk, guys, it's investment advice, not specifically to you as an individual, but in general, I am trying to give you some advice and some knowledge, more importantly. But from BMO's lens, purely educational, not at all to be deemed investment.
Thanks, Larry. So in terms of in 2022, we've seen clients, pre-retirees, retirees, they're on hunt for income solutions to have that monthly stable income. With inflation at all-time highs, not just in Canada, but across the world, that hunt for yield is even more needed for these clients. So if you kind of look at, CPI, in Canada, it's approximately around 7%. However, if you look at fixed income or, just dividend solutions, the yield there is around 4%, 4.5%. And this is where, this motivation of covered call strategies come in, where we are holding dividend underlying portfolio and writing calls on top to generate that extra income or extra yield to help supplement that monthly income required by retirees or, for any monthly expenses. So we can see here that, if you look at ZWC, which is the BMO Canadian Covered Call ETF, it's yielding close to 6.5% on an annualized basis, which is very close to the inflation levels within Canada. So it provides that, higher yield and sustainable monthly income versus some of the other alternative options, such as fixed income or even just pure dividend strategies. So if you go to the next slide, we can kind of dig deeper on how this strategy is constructed. What's the thought process behind it. So here, we have a chart with 30 years of data on the TSX, and we have split it into 4 different groups. Starting from the left, which is dividend growers. So these are companies that have grown their dividends on a regular basis. So, really good example here is Canadian banks. Then we have the dividend payers. These are companies that are consistently paying dividends. They might not have grown, every year, but they are consistently paying dividends every year. Moving to the right, you'll see there's dividend cutters. These are companies that are actually cutting dividends due to, financial or balance sheet issues. And finally, you have the non-dividend pairs, such as Shopify, which are full growth and they haven't paid any dividends yet. And on the chart on the left is the total return. And you can see that the dividend growers and dividend pairs have actually done significantly better versus the TSX, and even much better versus the dividend cutters and non-dividend pairs. Versus the TSX, it's actually outperformed 2 to 3% on an annualized basis. On the volatility side, which is the right-hand side of the chart, you can actually see you're actually taking less risk by investing in these companies. And if you kind of think it intuitively, it makes sense because these dividend growers and dividend pairs, to be able to pay out consistent dividends, they need to have a strong balance sheet. So these are blue chip companies with very strong balance sheets, that are able to weather the storm, during market downturns, and be able to participate on the upside as well. So it provides you that strong upside participation without taking on excessive risk. So if you go to the next slide, we can kind of see how we select our dividend companies within the covered call strategy. So, starting with the foundation, or the base, as I like to say, the base for the dividend, the covered call strategy is actually a dividend strategy. So depending on the region, so within Canada, our underlying starting point would be the TSX. If you're in the US, it would be the S&P 500. So based on the region, we start with the underlying index. And after that, the first filter that we do is to see positive or stable 3-year dividend growth rate. So if companies are increasing their dividend, or they've kept it stable on a backward-looking 3-year period, they get screened forward. If we have companies that are cutting dividends, or they have never paid a dividend, they automatically get screened out, so they're not selected. Then what we do is we look at 2 things. One is the dividend payout sustainability and option liquidity. First, on the sustainability part, we want to make sure that the companies that are paying these dividends can sustain them in the future. So we have a few screens that we look at that look both on backward-looking and forward-looking on the sustainability. Furthermore, we also look at credit ratings for these companies. So we look at the fixed income credit rating, and we only include companies that are BBB or higher. So what that does for us is, if a company is having a worse rating, it shows that the market thinks that they might have trouble paying their bondholders. And if a company can't pay the bondholders, they'll definitely won't be able to pay the dividend. And that's why we screen for that as well. And in terms of option liquidity, we always screen for option liquidity to make sure that by writing options on these underlying securities, we're not having a market impact. And finally, in terms of weighting these securities, we use a total dividend available approach, which is calculated by taking your dividend yield for the company times the market cap. And what this does is it actually provides the portfolio with strong blue chip companies. There are other way of weighting these companies is by yield. But that's what happens with that is, just because a company has a high yield does not mean that they're financially stable. And we have seen that in 2020, 2021, where the stock price came down significantly and the yields for some of these companies are much higher. However, it was not sustainable for them to be able to pay these dividends. So having this approach of market cap into dividend yield allows the portfolio to actually have a strong blue chip dividend pairs. So this is how we kind of build the foundation of the covered call strategy. If you go to the next slide, I just wanted to cover some of the benefits of covered calls. First and foremost, the most important is being able to generate, consistent yield and enhanced yield for our clients. So the way the strategy works is we have an underlying stock. So for example, let's use BMO as the stock, and then we write call options on it, and we collect that option premium, and we pay that option premium out, which enhances the yield of the overall portfolio. So having, as I mentioned at the beginning of the presentation, getting this extra yield is important to retirees, clients who need that monthly income, and this is a great way of achieving it. Second is on tax efficiency. So all the covered call options that we write are taxed on the capital gains account, so they're not considered income. So which is a great benefit for our clients. And second is there's no withholding tax in these ETFs. So we have ETFs that have exposure to international markets. So this is a great way to gain exposure in the international market without having that withholding tax payment. Third is lower risk and volatility versus the broad market, or versus dividend portfolios that don't do covered call writing on top of it. So, and the thought process there is we're writing call options and we're collecting that premium. So if markets starts to go down, you have that buffer that you collected by writing that call option to help offset some of that potential loss on that stock. And on average, we did our analysis, and on average, we see a 10 to 20% reduction in volatility versus a non-covered call writing strategy. And finally, we write out of the money calls, or OTM call options, and so that helps us keep upside participation. And whenever the option expires or rolls off, we can rinse and repeat. So it's every month, every 2 months, we can rinse and repeat to ensure that clients are getting collecting the premium and getting that monthly yield. Moving to the next slide. So how does it work? So let's kind of get into the nitty-gritty of things. So first, step one is we hold the stock. So in this example, let's use BMO. So we hold 100 shares of BMO, and on the 100 shares, we can write one call option on top. So by selling the call option, we collect the premium. Sorry, we collect the premium, and then you can see in the chart on the right, the blue line is kind of the traditional payoff versus the red line, which is how we do the strategy in-house. And you can see that the BMO strategy actually has a higher payoff, and that's because we write slightly more out of the money versus our traditional, or competitors. And you can see here that, by writing slightly out of the money, you get that higher upside participation, but at the same time, you collect that yield. If you go to the next slide. Larry, yeah, perfect, thanks. So in terms of how does BMO implement the strategy? First and foremost, what we do is we only write call options on 50% of the portfolio. So 50% of the portfolio has call options written on it. The other 50% has no call options written on it. So that 50% has full upside participation in the market. Second is we use out of the money options, or OTM options. So depending on the stock, depending on the volatility of that stock, we can write OTM options. So what do I mean by that? For example, if the volatility is high, we can write 5 or 10% out of the money call options So on that 50% that we do write call options on, they still have that 5 to 10% upside participation on top of the premium that was collected. So if you look on the table on the right, it kind of, gives you a rough, a simple example of how volatility changes the OTM of the option. So if you look at, column 1, which is about 10% implied vol, and if you write 2% out of the money, the premium collection is only about 2%. However, as vol increases, so if you jump to, let's say, the last column, which is 25% implied volatility, we can see that, we are able to go further out of the money, 6 to 7% out of the money, and collect higher premium versus when volatility is lower. And, we are aware, we're very cognizant of different market environments. But based on that, we are able to position the options so that we get that maximum upside participation with high income. And finally, in terms of the term, so we write anywhere from 1 to 3 months, and this allows the option strategy to be nimble. So if there is any market environment changes, there's any news, we can adapt quickly. So that's why we write, shorter dated options versus longer dated call options. Moving to the next slide. So this chart, this table here, we have 4 charts, which basically shows 4 of the strategies that we actually implement at BMO, starting with US covered call, ZWH, banks, Europe, and Canadian high div covered calls. So let's kind of zoom, kind of dive into one of them. So if you look at ZWH, which is the US one, you can see it's yielding a healthy 6.5%. So I just want to, highlight a few things in the chart. The dark blue line is the dividend that is collected by the underlying shares, by holding the underlying shares. So for example, if we hold, Apple, anytime Apple pays a dividend, we're collecting that. The light blue line is the call yield. So that's the extra income that we're collecting by writing the call. So you can see it's substantial and it provides that extra income that clients are looking for. The dotted purple line is the out of the moneyness of our call options. And this is where, I wanted to highlight the active approach that we have. If you look at the beginning of, at the end of 2021, so November, December, that time we did see a market rally. At that time we can see the OTM of the call options going higher. So we're writing slightly more out of the money so we can participate in the upside without having a negative impact on yield. And as you can see, yield has been steady around 6.5%. And as you can see, as markets, 2022 was a bit rough for the markets. And you can see as markets started to come down, we started to adapt and start to bring down our out of the moneyness. And on average, within this portfolio, we're, around 9% out of the moneyness on average. This changes in different market environments, even different sectors. If you look on the table or chart on the right, which is the Canadian banks, they tend to have lower volatility. And that's why you can see that, the OTM is about 5.5%. Moving to the next slide. In terms of our capabilities, we are the largest option manager in Canada. On average, we trade 700,000 option contracts per month. On the chart on the right, you can see that we manage approximately 10 billion in AUM across 12 different option-based strategies. And these strategies are just not Canadian-based; they're global. So we have Canada, US, Europe, and we also have a lot of sector covered call options available. And this truly shows that we are the market leader in this space. We have the expertise and the team around it with all the tools and the risk metrics in place to ensure a smooth client return experience. Moving to the next slide. In this one, we can we can see in terms of the market in Canada, in terms of the covered call market share, BMO Asset Management controls about 2/3 of the market share. And you can see the second and third place are much farther away than BMO Asset Management. We launched our first covered call ETF almost a decade ago, 2011, and we have seen tremendous growth. And this just shows that this is what investors or clients wanted: strong income source, where and a few years back, fixed income did not provide that. So they lean towards covered call strategies, and still leaning towards covered call strategies to be able to provide that extra income to support their month-to-month expenses. Moving to the next slide. So here I just wanted to highlight the different covered call solutions that are available in the market. So starting from the top left, we have the different regions. So we have Canada, US, Europe. We have a global covered call. And then the second line, these are our sector ones. So we have Canadian banks, US banks, utilities, the Dow Jones covered call, and we also have technology covered call ETF. Also within kind of the international space, so the US and Europe, there is a hedged version available as well. And these are for clients who don't want to have that currency exposure. And also within US and the banks, the Canadian banks, we also have a US dollar denominated option available for clients looking for US income in US dollars. So a lot of options available. These are great core strategies that can be implemented in clients' portfolios, to balance out both upside participation, risk, and income, and a great strategy to build a portfolio around, in my opinion. Moving to the next slide. And we also have some all-in-one solutions where asset allocation solutions for our clients. So on the left-hand side is the ZMI, which is our BMO monthly income ETF. You can see the breakdown of the holdings here. So these are all dividend holdings, and this is a great solution. It's all-in-one solution for clients who want to have one-stop solution for income, and they don't want to worry about how much should I allocate to which region, which ETFs to buy. And the ZMI also comes in .U, which is the US dollar denominated option. On the right-hand side is a more balanced approach. So you can see the distribution yield is slightly lower. So this is for clients who want more growth, but at the same time, want a one-stop solution, want steady distribution yield, so about 2.5%, but want to have more higher growth or upside participation. And this is a great solution as well for clients who want that growth, but at the same time they want some income within the balanced ETF. We also have a .T version, which is basically pays out every month income, a guaranteed income, which yields around 6.4% annualized. So again, these both are great all-in-one solutions for clients who are looking to start off. Can be a core portion of your portfolio, and then you can build around it. And I also wanted to highlight one thing that all of BMO ETFs are DRIP eligible. So for people who are getting dividends on a monthly basis, and they might not need it right now, you can reinvest them by talking to your broker or advisor, depending, talking to them and saying you want to enroll in the DRIP plan, and you can reinvest it again right back into the ETF, which is a much more efficient way of deploying your cash back if the cash is not needed right away. Perfect. I think going to the next slide. I just want to highlight, we have some great, podcasts and videos here. So if you can please subscribe, that'll be great. And I'll pass it back to Larry.
Yeah, thanks, Om, very much. So again, folks, I'm kind of almost like straight out flat lying down here in a chair that's kind of like this, just given that it's harder for me to sit upright, more stress on my spine that way. Anyways, thanks a lot for that tonight. That's going to be a great primer for our conversation in looking at very specific option strategies. So thanks a lot for being here.
Perfect. Thank you so much, Larry, for having me.
Okay, moving on to the next slide. So everybody's got a YouTube channel these days. and so, again, remember that all our educational efforts, on a go forward basis are going to be focused, on YouTube versus some of the other platforms. Seems to me that that's kind of the best one going for this stuff. If I seem a little bit out of it, folks, tonight, I am. so bear with me, please, as I try to get through this. It's been a pretty exhausting couple of days getting ready for this surgery here. Okay, so I wanted to talk a little bit about what I started to do on my educational segment on BNN this week. So take a little bit deeper dive on that, and that is how I think about energy, not how you should, but how I think about it in my portfolios. Been asked a lot recently, why don't you have more exposure in energy? And we actually did. We were overweight energy a little while ago, but being very tactical, I trade it. It comes out of the portfolio. I replace it. I change the risk. So I want to talk a lot about that in terms of changing the risk and how I use options in some of the portfolios I write and work with. Now, in the public mutual funds that I manage for BMO, there are some strategies that Om highlighted tonight that they do. I run the ZZZD BMO ETF, and that one, I don't do my own covered call writing. We do use option strategies to hedge and protect the portfolio, to dampen the volatility, to give it some of that sleep at night factor, when markets are going through difficult periods, sort of like they are this year. I will try to get some of your questions and answers tonight, but again, we're going to try to keep it tight, and it's going to be a little bit shorter tonight than it normally is. So first slide here is the chart I featured on BNN this week, and all the first three charts are the ones that I featured on BNN this week. And, when asked about, why I'm not bullish on energy, and so the narrative right now in the market is very clear. Because of ESG and governments and everything shifting since the Paris Accord. The Paris Agreement was signed after COP21. Most of the countries in the world signed on to it. And so what I did was I looked at the total return of a couple ETFs that represent Canadian and US market exposure, and I compared it with the Global Clean Energy ETF, ICLN, that's been out for more than a decade now, and looked at those different returns. And what you can see here very clearly, where the green line is the clean energy, is that sometimes they go up together, sometimes they go down together, sometimes they diverge. And as one starts to grow and expand from a secular trend basis, from a multi-decade into the future trend, and the other contracts from what was decades of crude oil and energy powering the world, we're in transition. We can debate climate change, we can debate a lot of things, but what is very clear to me is that the trend is moving in this direction. You can fight it if you like, but as someone who's a trend follower and thoughtful around understanding, market movements and investment themes, this kind of, stands out to me. So when you looked at this, for the end date of this picture, I picked the pre-COVID period. And I picked it because of, well, for the obvious, energy prices turned negative for the first time in history, as the world shut down. And we know that happened in April of 2020. And I didn't want to skew the data that way, and I wanted to keep it, cleaner. Now, what did end up happening a little bit, as we got into 2022 was the anticipation of Russia invading Ukraine. And I'll talk a little bit about that in a few slides. But, from this perspective, what started to happen late 2018 and 2019, and if you look and think about what was going on at that point, the political campaign season started to take off in 2020, US election. And many will say that if it wasn't for COVID, Trump would still be the president. And I actually wouldn't disagree with that statement in a big way. However, I did feel that Trump, he's such a polarizing figure that he set himself up to lose the election, and ultimately COVID was what really pushed the envelope. But I had talked about inequality and lots of other things back then that has actually played out pretty real time. But technology started to really change and develop for batteries, for lowering the cost of solar panels, and the semiconductors and technology that drives them in a big way, really starting in and around 2018, 2019. A lot more, not so much policy in the US because Trump, turned that off. But really it was the technological innovation that really is groundbreaking. I'm going to be doing an interview with Kathy Wood from ARK ETFs, and it's going to be the last episode of this series on December 8th, and that's going to be very interesting. Don't miss it. Part of that conversation is going to be digging into a little bit about what disruptive technology. So the clean energy revolution is a disruptive technology to the traditional energy sector. And that's kind of my lens here, folks. And, when I observe trends, that's one of the things. So if we cut this off in 2018 and said, okay, well, at that point, what would you invest in? What almost everybody does, and individual investors do this a lot, is you look backwards and you look at past returns and say, what should I have bought? And of course, at that point, the CI Energy Giants Covered Call ETF, at the end of 2018, before that little meltdown we had there, was looking really good compared to some of these other ones. And you would have, at that point, bought that ETF because you would have looked at the past returns to do that. And of course, that wasn't the right choice. The right choice, with the benefit of hindsight, was the green line, but you may not have made that choice. And my point is that you have to build your toolbox, understand the tools, ETFs in this case, but could be single stocks, and know a little bit about what your forecast is for the future, and then what the best vehicle might be to affect that outcome. And that's really it. So covered call strategies are a style in which, when you're a bit more conservative or negative, or have a yield focus, that's more appropriate for your portfolio. But if you don't have a yield focus and you're making directional trending bets, you don't want to use covered call ETFs, because even though BMO does them very well, and certainly CI does them very well, they're not going to give you the upside necessarily you need in a strong upward market. But from the lows in 2017, CI and the covered call giants ETF did actually very, very well compared to, say, the broad energy select ETF in the US. So, having started from about the same point in 2017. So that's kind of interesting understanding. So while there's rules of thumb and when you should use covered calls over not covered calls, and typically when you're bullish, you don't want that extra yield. You want all the upside of the underlying stocks. It isn't always the case. It's mostly the case, but it isn't always the case. There's this concept called path of returns, and terms of how you get from A to B. So if your A to B is like this, and it's mostly straight up without a lot of this, then you're probably going to do better in a direct long position, because the volatility, while enhance the yield in the covered call, could actually hurt you. But it may actually help you if on the pullbacks, those aren't the periods you're writing the calls, but during the strength, you're writing the calls. So you're getting the better premiums, and then it sells off and you're not writing until the next peak, and so forth. So concept called path of returns, and you don't know what that's going to look like. So that's another important concept. But traditional energy is in a structural decline, and I'm a firm believer in that. Again, you can debate me. I remember a few months ago, I did an educational segment where I said, buy ICLN and sell, traditional energy. And you can go back and look at my Twitter feed, and you can see some of the hate ETFs. Oh, Berman's an idiot, that kind of stuff. Listen, it's just a market call. It's Berman making a call. But it was during this peak here where what I had suggested was, okay, I think oil's priced fully for now. Let's sell some of this, and let's buy this that's been underperforming, the green energy. And so if you looked at that trade for the next 3 or 4 months, it was actually a winning trade, right? So this is what I'm saying about rebalancing. So coming out of COVID, let me take the step back. It was clear everything kind of went down. The world shut down. Fed threw lots of money at it. Looking like Biden's going to win the election. Boom, the Democrats win the election. Traditional energy stocks do relatively poorly. Green energy does great. We're going to spend a lot of money, AOC, all that stuff that actually never really happened. They ended up passing a bill called the Inflation Reduction Act. Oh my God. Anyways, don't get me started here on election night on that. But November 9th, I believe, was the day in 2020, COVID Monday. Energy stocks, the world started reopening. Energy started to do better. And as the failure of, or anticipation of what was never really, you had this bubble come in. And then it's kind of gone sideways ever since. When you think of bubble, correction, and really the green energy's gone sideways as traditional energy has taken off. The world's reopening, China this, that, and the other thing, shutting down, stop, start, all that impacting. But it really wasn't until, February 25th, right in here. And I'll blow it up here in a second and show you the last year where Russia invaded Ukraine, where pretty much all the gains have come year to date. So again, what do I want to own today? I look at it and I say, I want to own this that has a much better longer term potential than this that's pretty much fully valued at this point. Now, again, you can ask Eric Nuttall the fundamental story, and he's going to paint his picture because he runs an energy fund, and that's his very smart guy. I listen to him all the time. I also listen to a lot of other people. I believe that we're a lot closer to peak oil demand, and I get the supply and underinvestment story. And for the next few years, it's very, very, very real. Absolutely. And this is why I'm talking about transition in moving away from old energy to new energy. Where do you want to put your kid? You have a kid born today. For the next 20 years to fund their educational, do you want to put money in dividend paying old energy stocks, or do you want to put it in green technology growth? Just asking the question. I know the answer where I would put my money and where I will, not for my children, but for my grandchild who's turning 1 in a few weeks. It's innovation, it's technology, it's disruption, it's long-term growth, being very mindful of these bubbles that we get into and the extreme valuation from time to time. So looking at the last part of this where we blow up the current year, again, I can't do these deep dives on BNN in a couple of minutes. I just don't have the time. So February, boom, right there, third week in February, Putin rolls into the Ukraine and humanitarian crisis and everything else. And the oil names, whether it's covered call or whatever, do a lot better than the green energy names, where Biden's done a terrible job. We've got this inflation. It's coming up to the election, and all of a sudden, no green agenda. And so these kind of lag. And that includes what I added here, uranium. I've talked about this as being a very important transitionary metal. I believe that you got to trade the name. It's not investable. It's a highly volatile sector. It's tradable. Maybe for the next few years, it could be investable. But the volatility here demands you trade it, understand how to use options around it, etc. But I'm advocating that we create an ETF that understands what's happening as it relates to ESG and the transition period from us burning carbon to us using sun, wind, uranium, hydrogen, green energy, to transition to it. Natural gas is going to be a big part of that. But we got to get off coal. Germany's decision to get off of uranium and nuclear after Fukushima was not very thoughtful. Now, did they understand what was going to happen with Russia and Ukraine? Probably not. No one could have really forecasted that. But after Russia rolled into Crimea, did you not think there was going to be another leg to it? Anyways, I won't get into German politics, but nuclear is difficult because it's for most people, it's not in my backyard. You may have recalled a few months ago where Russia was doing, there were some fires at Chernobyl. Like, anyways. Okay, so getting back to this, I like right now to be more defensive in traditional energy and more aggressive in clean energy here. And it has nothing to do with the election this week. You know, I'm pretty sure Congress, by the time you guys are watching this, will have flipped in the House to the GOP with a strong enough mandate. They can't pass any laws because they're not going to get 60 seats in the Senate to pass things without the president's veto. And for the next 2 years, you can bet that Biden is not going to pass anything that Congress puts forward other than stopgap and continuing spending resolutions to fund the government. But it's so you've got this gridlock. Some of the thought is that in that environment, it's overall good for equities. And I would submit, in the face of a Fed that wants equities weaker as a fight against inflation pressure and consumer spending, that equities aren't going to be able to move material higher here. And the Fed will end up taking the punch bowl away. That will have an impact on earnings, and I don't think 2023 is going to be a particularly good year for equities either. So anyway, so with that in mind, let's start at a simple level, and let me bring up my Bloomberg here and have a look at the energy sector and ETFs. So there's a lot of ETFs that you can trade and use, and there's leveraged, and Fidelity has them, and Vanguard and Invesco and First Trust, and there's natural gas, and there's bulls, and there's bears. And so, you know, at the simple level, you can trade them both ways. Doug is a 2 times bear to play oil and gas from the short side, basically shorting, you know, the energy names. And it would be like a short of XLE. And then you have DIG, which would be a 2 times bull. And so obviously the last couple of years, you know, looking pretty good year to date. So again, if you're going back and looking and say, which one do I own? And you look at performance, why, you know, here's the one I want to own. Where if you went and looked at Doug and you looked at the performance tab here, that doesn't make any sense for me here. Sorry, folks. My screens aren't behaving for me here. Pardon me. Here, year to date here, down 75%. I was looking at the wrong bucket. That was the underlying index that it's trying to beat. So, you know, you get that, you know, that sharp inverse. And why would you want to invest in that? So let's go back to the charts. And so my simplest chart that I like to look at from a very, very simple perspective, relative strength index, RSI, overbought, oversold. So, you know, you've got this potential double top here with the highs made earlier this year. Could the sector move higher here? Absolutely, it could. But risk reward here to me is negative. So let's say you own the XLE. What would you do here? Well, in the BMO world, if you're thinking how explained BMO strategy, now they do this with the individual stocks, but we would say, okay, what are the calls trading for? And so we bring up our call tree here, and we look at December, and we say, okay, we're at 93.08 today. If I wrote a 93 call, I would take, if I hit the bid, I would get $4.10 for it. Last trade was at 445, so I could probably get 440, 430 at least. Typically, there's going to be a spread, and on liquid ETFs and stocks, the last trade's going to be somewhere in the middle of that band. If it's not liquid, then the spreads are a little bit wider. So if you wanted to do it right at the money and you didn't think there was any more upside, that's probably your best option. And you can see between now and the middle of December, $4 on a $93 ETF, quickly doing the math, about 4.5% in yield, in premium. But if you thought, well, maybe there's a little bit more upside, okay, what could it get to? So let's, for round number sakes, let's call it 100. I don't know why. So between now and the middle of December, you think it can go a little bit more, but you want to enhance your yield. So you can write a 100 call and take in $1.42 at the bid. Last trade 169, so call it $1.65, another 1.65%, less trading cost. So that would be potentially something you could do right now, as a strategy. If you were long XLE, you could sell XLE and say, you know what, I like it longer term. Larry, I like this longer term, but right now I think the risk is high, but we're going to get a pullback if there's a recession next year. And where is that pullback going to be to? Okay, let's go look at our charts. So where are we going to pull back to? Well, let's call it the 200-day average. Let's say we're comfortable every dip to the 200-day average the last few years, buying opportunity. Let's say we believe that to be true and it continues. So let's put our chart out like this and say, okay, where is that going to project to into the first part of next year? So let's call that, I don't know, just above 80. All right, fair enough. Now, obviously, the lows below 70, that would be a little bit better risk reward to buy a dip. So let's say 80 is my support point, and anything below that, I'd be comfortable buying, okay? So we've done that analysis, and let's say we believe that the weakness, February, second weakest month of the year, and maybe we'll look at that as a timeline. So February, March. So let's bring up our options again. And let's roll out and have a look at, let's look at March. Okay. So what are the March, we'll center it around 80. So a March 80 put, if I bought it at the ask, 3.25, last trade 296, let's call it $3. We could buy this, okay? Maybe it's 310. So for simple math, we'll call it $3. So I'm gonna buy the 80 put at $3, and I wanna buy it, let's say in the low 70s, risk return, right? We looked at those charts, anywhere below that $200, dip buying opportunity, let's call it 75. Okay. So what I'm going to do now is I'm going to buy an 80 put for $3, and I'm going to sell two 75 puts, and I'm going to get $2 for it, right? Right in the middle of the bid-ask spread, last at 198. Again, the actual fills might be slightly different than this. I'm just doing this for simplicity and for example purposes. So now I've sold two, each option doing 100 shares, and I bought one. So I paid $3 and I got 2 times 2, $4. I've now taken $1 premium. So I'm gonna earn $1 on the ETF I just sold for 93. So a little over 1% between now and March 17th, 23. I'm expecting a correction, but I'm going to earn that dollar for sure. If it's at 80 or below, my 80 put is now in the money. And down to 75 cents, I could make up to $5. Okay. So now I got my dollar. I can make $5 more. So now I can make $6. But below 75, I now have to buy twice as many, 200 shares. Okay. Let's say on March 17th, best case scenario, it's at $75 even. I make $6. That's my profit. And I don't have to buy anything. If it's at $74, I need to buy 200 XLE at 75. So I'm going to be down $1. Remember, my puts are still protecting me. So I'm down only $1 on 100 shares. But I've got that $6 profit still. So it's actually not until it's at $70 where I'm at risk of really starting to lose money, because my profit on everything else I made is covering that extra weakness. So that's actually a strategy right now, today, that I'm looking at implementing in my ETF portfolios for clients, because I don't want to own XLE here. I don't like the risk at all. Risk return to me is wholly unattractive. Now, if you're bullish, that's a whole different story, but I'm not. We're going into a recession. In a recession, the energy stocks are going to do poorly. So you could buy the DUG ETF to play the bear and do that from here. If you're long, you can sell it. You can use an option strategy like what there's 100 different strategies. You can do a covered call, and you can keep the underlying, and you keep earning your dividends. There's so many ways, folks, to put on a position, and it's really endless. The number of combinations are really, really, really endless on how you do this. If we get into the individual holdings, so let's look at and I'll give you a stock example. What moved today? Again, this is Tuesday's market close before the US election. What moved today in the ETF? You can see it was kind of flat on the day. On an intraday basis, ETF was weak, oil prices rally, weak, rally, weak, rally, rally by the end of the day, almost unchanged and closed on the uptick. So basically unchanged on the day, slight uptick at the close, but really lots of noise, lots of volatility, about 1% at the weakest, about 0.5% up at the high, but pretty close to unchanged. When you look again at what moved on the day, you had the gassier names, on the downside, and you had the refiners and the pipes a little bit better on the day. When you look at the commodities today, what you see is red across the board. So all the commodities, whether it was gas, heating oil, crude, or nat gas, everything kind of got hit hard today. So kind of interesting, the stocks hung in there on a day the commodities were particularly weak. But let's just pick ExxonMobil, big liquid, biggest weight in the index. Actually, let me just verify that if it is still the biggest. If I look at the holdings of the ETF, yeah, Exxon's still the biggest. Represents 22.71%, Chevron second at 19, and then some of the drillers, Schlumberger there, SLB, I guess they're changing their name to. Something about the Schlumberger name they want to get rid of, I think. In the woke world we're in. So let's go back to XOM. Okay, so individual name. Remember, the sector is bumping up against the May, June highs. ExxonMobil breaking out. So you may want to say, hey, now I've told you a million times in the past, I'm a guy who I'm not a breakout trend chaser. I see this, I get very, very nervous because when I go back in time and I look, to me, back in here, before fracking, before everything else, ExxonMobil, to me, this is absolutely insane what's happening here. I get the share buybacks. I get we're front running because there's going to be a tax on share buybacks. I get all that. And for a trade, you may want to do that. 100%. However, understand this is a really, really, really not good time to be investing for the long term in this name, given that longer term chart I showed you. And so the exercise here is, how do you buy a pullback if you want to own it? And again, let's look at our option strategies. So, puts are the way to do that. It could simply be, what price at that chart are you comfortable owning ExxonMobil? So let's say that's $90, okay? It's not 114, it's 90. You're comfortable at 90. Okay, so where can we buy this at 90? So let's center our option strike at 90. And if I wrote a 90 put that's expiring next week, I'm getting 3 cents for it. Okay, so that's not a trade I want to make. Let's look at December, 90 puts, 29 cents. Okay, that's interesting. So for a holding of right now about a month and a half, a month, 5 weeks, I'm going to get 29 cents for it, less my 28 cents US dollars. Convert that to Canadian, about 35 cents. I'm getting a yield of about 40 basis points for 5 weeks of, that's kind of interesting. Let's extend that out to January. Okay, now we're starting to get up closer to 1% in terms of premium. Okay, remember what said at BMO, they look to generate their covered call premiums 1 to 3 months. Folks, that's about the sweet spot in terms of earning your yield and premium. You could go out a year. Okay, so let's go out now to January 24. Okay, we're going out more than a year here. I can write a 90 and get $6.20 premium. So that is around 7% based on a $90 price. 7% of 90 is $6.30. Okay, so based on a $90 price, I'm getting about a 7% yield for a little bit more than a year of risk. Again, on January 19, 2024, if it's below 90, I got to pay 90 for it. So you got to be kind of comfortable with that. That's why when you go further out, your yields are higher, your premiums are there, but there's more uncertainty, right? And because you wrote the option, you're locking in your obligation. You can buy it back at any time, but you may have to do that at a higher price, etc. So, the naked put is always a great option for earning yield. We do this a lot in our yield portfolio. ZPay ETF does this, where they're looking at companies they want to own at what price. Couple months out, they write the put. If it gets there, they got to buy it. You got to want to own the stock, but there's a lot of ways to play it. When you look at XOM, because they talk about the yield, right? And you look at, so for owning the stock outright, 3.19% is your yield. I just showed you double that yield. You get no upside. Keep that in mind. You get no upside with that strategy of writing the 90 put. But if we do go into a recession and this drops back to the 200-day average, you've got a much better risk reward than owning ExxonMobil here. And so that's really some of the thought process, folks, behind some of the option strategies and how to use them and how I think about them and how we use them in our portfolios, and very specifically our global yield fund. So if any of you out there are interested in our strategies and our funds that we manage for the partners of Q Wealth, reach out to one of our partner companies and ask. And we'll be glad to kind of show you what we do there. So let me get into some of the Q&A tonight and see what happens. So your prediction for US elections this week, a red wave. So by the time I've answered this question, we'll probably already know, because again, this is Tuesday night. All the forecasting tools, and I believe this time around, the call of the House, moving to the GOP is somewhere between 5 and 10 seats advantage over the Democrats, and so I expect that. I don't believe on election night we are going to know who controls the Senate, and I believe it's going to be close enough in Georgia that we get a runoff there, and the question will be, does Pennsylvania, as we talked about last week, tilt towards Dr. Oz or stay with the Democrats and the new potential Senator Fetterman, because that seat is up. The existing senator's retiring. So either way, you get a new senator, and the question is, does it stay blue or does it turn red? And the last minute push has clearly shown that Dr. Oz might have a slight edge. We are going to see on election night, because like we saw with the Trump election, that it's going to look like Oz is the winner on election night, because they won't have counted all the mail-in ballots, which generally speaking are far more Democratic than they are GOP. And that may not be known till the very early mornings. It may be contested. It may be that close. I hope it doesn't come down to that. I fear it may. It could be weeks and weeks and weeks before we know who controls the Senate. But folks, it doesn't actually matter, because as long as the House is Republican and the White House is Democratic, we've got gridlock in Washington for the next 2 years, and not a lot of money is going to get spent. And from an inflation reduction bill, that is going to help considerably, because you're not going to have excess deficit spending that would push interest rates higher, that would stress financial assets. Because make no mistake, it's the inflation, it's the Fed tightening that's the big stress to financial assets now, and not really the economic impact. That is still to come in 2023, and one of the reasons why. So I don't think the election matters really at all tonight. Outlook for the Ether ETF, and that this person says they hold the purpose one. So again, I'm an outspoken critic on Ether. I didn't even know the ticker to the Ether ETF. Okay, so Galaxy Purpose, ETHH. There it is. So we'll know that there was some cyber crypto exchange issues. There were capital issues. I'm not sure exactly what happened there today, but all of crypto was really, really volatile on Tuesday, and it was related to, again, this is a early stage speculative, highly speculative industry that I've called a Ponzi scheme, and I believe it is. It is a great example of limited supply and demand, and how basic economics works, where you have more demand than supply, price rises, and so I think these are tradable assets. To come out and say that retirees should put money in this, I believe is, what the San Salvador, I believe, government did. Like, maybe emerging markets are helpless when it comes to, strong dollar. How do we protect ourselves? And so, yeah, I get that. But turning cryptocurrencies or bitcoins into a national currency is an absolute mitigated. That was expletive deleted, folks. Stupid, idiotic, moronic move, and I can't be clearer on that. So crypto assets can be traded. I don't believe you can invest in these, but there's a lot of backing. Gary Gensler tweeted last week, I believe, and I actually commented on the tweet, said it's the 14th or 15th anniversary of Satoshi Nakamoto's white paper on crypto, and congratulations. And, we've got to govern and regulate the sector. And, again, I said Charles Ponzi would be proud that you're getting institutional backing and support for crypto assets. So they're a thing. They may be a thing for a long period of time, but if you ask me what they're worth, they're absolutely worth what the next person is going to pay for it. And if you don't believe that fundamentally, and you believe that this is some independent, free-thinking currency, we've got a debate on our hands. And I love the debate and discussion about this. And there are lots of opinions, and there's no right or wrong. So what is Ether going to do? I have no idea. Blockchain and disruptive and DeFi and what all that, very, very, very bullish on disruptive technology. Again, there's a difference between a good stock, a good company, a good idea, and a good price. So is Coinbase a good company? Well, as long as crypto exchanges are there and it trades and it's active, that company probably can make some money one day. Who knows? When that is, I have no idea. But if you look at some forecasts on what it's worth, was it ever worth what it IPO'd at? In my humble opinion, no. Did it capitalize on the top of a bubble? Absolutely. Anyways, I can go on and on about the crypto space, and I have no opinion. You trade it technically. Know that it's going to screw you around at every opportunity. If you're really serious about investing in it, buy it, put an amount of money in it, and never look at it again. Because the volatility will shake you out of your position for the average person. 100% virtual guarantee on that. And that's just kind of my view on cryptos in general. What will the Fed do next in terms of interest rates? Market have been roller coasters. At time to slow the pace of rate of increase, stabilize the economy. So, we're not there yet. Powell was very, very clear in his last press conference that it's far too premature, but we get some important inflation data. Again, by the time you see this webinar, the CPI report would have come out. The PPI report would be out the Friday morning of this week. And so I don't know what that number is going to be. Expectations and behavior has been very much gilded to, if that number is a little bit worse than expected, asset markets have a very bad day or week to follow. And if the number is a little bit better than expected, the markets will be okay. It would have to be a material improvement in the number for the asset markets to be able to rip higher because of what Powell had said about taking the punch bowl away. And I would encourage people to use a rip like that, call it somewhere above 3,900, 4,000 on the S&P 500 to take some money off the table, not to chase a breakout at that point. Could it go higher? It could, but they want to take the punch bowl away. I think we're at 3,200 before we're at 4,200 on the S&P. You can quote me on that. It's a Berman's call. It could be wrong. Can I please explain what VXY ETF is and who would it appeal to? So let's have a look at the description. Short-term futures ETF, exchange traded fund, seeks daily investment results that correspond to the performance of the VIX short-term index before fees and expenses. And there's your ticker of that index. And so what is it? It's basically your trading volatility. And so if you did that, you can kind of see what that looks like. If I do a graph ratio, what that allows me to do is to put that up against the VIX index. And so you could see, VIX goes up and down. So VIX is the ETF goes up and down. And you could look at that on a price basis. So when I click this normalize button, what that does is throws everything into percentage terms. So now these both start at 100. And so you can see that the VIX is up 48% from a year ago, spot VIX, and the ETF that does the tracking of it is actually down 16%. And this is the underperformance. So the ratio of those started at 1 and now. And so this is what happens with these derivatives that track. They're for short-term trading and short-term trading only. They are not for long-term investing at all, at all, at all, at all, at all. I can't underscore that and emphasize. So who's it appealing to? It's appealing to someone who has a forecast that's relatively short-term, days to weeks, that the market's going to correct, and that you want to buy something that's going to go up when the market corrects. You could buy a bear ETF that tracks the S&P that would go up 1 to 1, 2 to 1, 3 to 1, so forth, if the market goes down. Or you could trade it by way of trading volatility linked to the volatility futures market. And I would submit the volatility traders and the people who really understand volatility are some of the smartest people out there, with advanced degrees in statistics and an understanding of how this stuff trades. And for the average investor, without disrespect to any individuals out there at all, don't try to do this. It's too friggin' difficult. And I'm someone who's an expert in this stuff. And I understand option pricing, and we use them extensively and actively. And I'm telling you, it's friggin' difficult. Okay, so for the average investor to time markets is very hard. For the average investor to time volatility you're making that because you have no time here. Decay, this time decay is going to work against you always. And so let's say you made a call to be bearish on the markets and you know, VIX spiked and you bought it here. And you didn't get out of it here or here, and now you're holding this thing. Volatility doesn't spike. Oh, volatility spikes again. But your mindset, folks, is I got to break even on this thing because I bought it here. And it doesn't get back to the price and then you don't sell it there. And now another few months go. Finally, you're out. You got back to even. Oh, thank you. I'll take my money back. I'm out. It took several months. You made the right call on volatility because volatility was ultimately went higher. But if you look at the time here, so I'm talking about November of 2021. So let's just make a mental mark of that. So now what I'm going to do is I'm going to replace this VIXY with SH. And SH is the single short of the S&P 500. So had you bought that here, end to end is far more neutral. And if you bought it here, again, if you didn't get out here, fine, you have to wait. But you made money here, and then you made a lot more money here. And so SH for most people is probably a better way for a longer term hold. It's a single inverse of the markets versus trying to perfect trading of volatility. And for the average investor, folks, that's a real important takeaway. And the last question of the night, BMO ZUE is a hedge to Canadian currency. Can you explain what that means and why it's important? So a couple weeks ago, we had, I think it was Erin on, and she talked about currency and hedging. And so if we look at the comparative returns between ZUE, ZSP, those are both the identical holdings, S&P 500, one's hedged, one not. And then we throw in FXC, which is the currency share Canadian dollar ETF. And you look at, and so the difference between the hedged and not hedged version is effectively what the Canadian dollar is doing. And if you looked at that spread there, that's what you end up seeing here. So very much it's to be hedged or not hedged. If you are bullish on the outlook for the US markets, you want to have exposure to the US markets, but you generally are going to be risk on, and that means the Canadian dollar tends to get stronger to the US dollar during risk on. So let's roll this back a year, 2020, and let's make this 2021. And so this was a risk on year. And so what generally performed better? Well, the Canadian dollar was stronger on the year. And so you want to have that exposure hedged. So when you're bullish on the US market, you want to own ZUE on average. When you're bearish on the US market and you expect the US dollar to get stronger, you want to own ZSP. Okay, so that's your rule of thumb. When you're bullish, you want the currency hedged exposure. When you're bearish, you want the unhedged exposure. It helps mitigate some of the bad periods like we've seen this year because you benefit from the Canadian dollar weakening, and that helps offset some of the losses that you would typically see in the markets. Folks, that's all the energy I have for tonight. That's all the time we have for tonight. I actually did get through a full 90 minutes. Thank you again. Please, 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 if you want to thank us, try to support one of our charities. In the email that you get, click one of the links, make your donation. We match all your donations up to $25,000 a year. It's a great way to double up on your efforts to these two very important charities. And if you are interested in any of the funds we manage, financial planning, and some of our educational exposures out there, please visit one of our partner websites. Thank you, guys. 2 thumbs up for my back surgery. Hopefully, we'll see you next week. If you don't see me on BNN on Monday, there's a good chance the surgery didn't go as well as I hope, but there shouldn't be a problem with that. Have a great week, everyone.